Welcome to Talk Tickers. Today we are diving deep into the third quarter 2025 results for the EWC Scripps Company.
That's right. Our goal here is to really unpack the narrative from management, get behind the numbers and understand what's driving their recent success.
Especially in what seems like a pretty mixed advertising environment.
Yeah, exactly. And the initial tone from management, it feels like they're executing. There's a sense of building momentum and a lot of confidence in their forward guidance.
Okay, so let's get into it. This is their third consecutive quarter where results either met or exceeded expectations. So there's a pattern forming.
There is.
But the headline number might throw some people off. They reported a Q3 loss of 55 cents per share.
Right. And that number needs a huge asterisk next to it. A massive one.
So what's the story there?
Well, you have to ask, is it an operational problem or like a financial cleanup problem? And for Scripps, it was all about the cleanup.
Okay.
You had a 15-cent hit just from things like debt extinguishment, new financing costs, restructuring, all non-operational stuff.
And that's on top of an 18-cent reduction from the preferred stock dividend calculation.
Exactly. So the real underlying operational picture is actually a lot healthier than that 55-cent headline makes it sound. They're taking the pain now to clear the runway.
And you can see that paying off on the balance sheet. Net leverage improved significantly.
It's the real story of the quarter, I think. It dropped to 4.6 times at the end of the quarter. That's down from 6.0 times just a year ago.
Wow, that's a huge drop.
It's an enormous reduction. It just signals that their number one priority is paying down debt fast.
And speaking of that, they made some pretty smart moves with asset sales. 2 stations, I believe.
Yeah, WFTX in Fort Myers and WRTV in Indianapolis, set to bring in about $123 million in cash.
But it's not just the cash, it's the price they got, right?
Oh, absolutely. This is the part where you have to pause and really look at it. They got multiples of 9.2 times and 8.5 times 2-year blended EBITDA.
Which is good.
It's fantastic. It's well above what local stations are trading for right now. It tells you 2 things. 1, these are high-quality assets. And 2, management knows how to extract maximum value.
So they're selling smart. Let's dig into the actual operations then, starting with the local media division.
Okay, so headline revenue there was down 27% year over year.
Which sounds catastrophic.
It does, but it's not. That's just the political ad cycle. Last year was a huge political year. This year isn't. So you expect that drop.
Right. So if you strip out that political noise, how did the actual core business do?
Core advertising was actually up nearly 2%, which is a really strong result in this market. And that's driven by their services categories. And this is the important part, their sports strategy. Distribution revenue, by the way, was flat.
And they kept a lid on costs, too. Expenses were down 4%.
Yeah, mainly from lower employee-related costs. They're running a tighter ship, and that's all setting up for a really strong Q4.
What's the guidance look like?
The guidance is robust. They're expecting core revenue in local media to be up around 10%.
10%, and that's the sports strategy paying off.
Directly. A lot of that is from the new NHL partnership with the Tampa Bay Lightning. It's an immediate payoff.
Okay, so that brings us over to the Scripps Networks division. How did they fare?
Revenue was basically flat at $21 million, which, as management pointed out, is actually a great result compared to their peers who are seeing declines.
And within that, I saw a huge number for Connected TV.
Yeah, this is the engine. CTV revenue surged 41% year over year. That is what's pulling the whole train.
And margins were strong.
Very strong. A 27% segment profit margin in Q3. Very efficient.
But the guidance for Q4 in networks looks a little weaker. Revenue guided down low double digits. What are the headwinds there?
It's kind of a triple whammy of external stuff. First, they lose over $10 million in political ad revenue they had last year.
Okay, the political cycle again.
Right. Second, the general upfront ad market was just weaker this year. And third, they saw less advertising for Medicare open enrollment. And they think that was partly due to the government shutdown uncertainty.
Let's pivot back to the balance sheet then, because that feels like the strategic core here. They placed $750 million in new notes.
Yeah, this was just textbook debt management. The goal was to push out their maturity wall, and they nailed it.
So they used the proceeds to what?
They paid off their 2027 notes completely, knocked over $200 million off the 2028 term loan, and get this, They paid off their entire revolving credit facility a full quarter ahead of their own guidance.
So what does that mean practically?
It means they have breathing room, a lot of it. No major bond or term loan payments are due until 2029.
That's a huge reduction in risk.
A massive reduction. They basically bought themselves 5 years of security from whatever the interest rate markets do. And they expect to pay off the rest of that 2028 loan just using cash flow.
So the house is in order. Now let's talk about the growth drivers. The sports strategy is something they keep highlighting.
It is, and it's because it's so different. They aren't chasing, the NFL. They're being smart. They're going after affordable high growth rights. Women's sports like the WNBA and NWSL, local NHL teams.
And that's working.
The numbers don't lie. WNBA revenue on their ION network nearly doubled this season. Their total sports upfront ad volume was up 30%. The WNBA specifically was up 90%.
Wow.
Yeah. And that's lifting their core local ad revenue by several percentage points every single quarter. It's not a vanity play. It's driving real high-margin revenue.
The other engine seems to be CTV and streaming.
Oh, absolutely. This is a revenue stream that basically went from zero to a projected $120 million for 2025 in just a couple of years.
How?
Aggressive distribution, pushing their content ION, Bounce, Court TV onto every platform they can, virtual cable packages, Peacock, you name it. Streaming is now 20% of all their network viewing, and it's still growing at double-digit rates.
And behind all this, there's a big push on efficiency and AI.
Yeah, fiscal discipline is the theme. They're using AI everywhere. In the back office, in the operating units. They gave an example of automating stuff in newsrooms to free up journalists to actually go out and report.
That makes sense.
And using AI to help the sales teams find new leads. It's about lowering costs while improving what they can do. We should see more financial benefits from that early next year.
Okay, so that brings us to the big picture. M&A. They're selling assets, but what about buying? Or a bigger, more transformational deal?
The strategy is simple. Buy, sell, swap, whatever makes the portfolio stronger. The cash from the recent sales will mostly go to pay down more debt, hammering home that priority.
But the big catalyst everyone is watching for depends on regulators, doesn't it?
It completely does. Management was clear that transformational M&A is on the table, and they said the controlling family trust is on board with whatever creates the most value for all shareholders.
So that sets up the macro and political outlook perfectly.
It really does. The national ad market is, it's fluid, but the political outlook for 2026 is a massive tailwind for them.
Why is that?
They have a huge footprint in all the big midterm election states. Arizona, Michigan, Nevada, Ohio, Wisconsin. They expect broadcasting to get the biggest piece of that political ad spending pie.
And the regulatory watch is favorable.
Very. Management expects the FCC to finally eliminate the prohibition against owning two big stations in one market and, critically, to get rid of the 39% national ownership cap.
And that ownership cap is the real game changer.
It's a steel ceiling on the industry. Removing it, which they think could happen by mid-2026, just completely changes the M&A landscape for everyone.
It just unlocks so much potential.
It creates a pressure cooker. And on top of that, you have major affiliate renewals with ABC and 70% of their cable contracts coming up in 2026. Those are huge revenue bumps just waiting to happen.
All right, let's get to the part of the show we call This Is Not Financial Advice. And we have to stress that we're not recommending any trade. This is purely informational for entertainment. A way to look at the market through a, let's say, creative lens.
Exactly. An outrageous but plausible pitch, because you've got all these different tailwinds converging on EWC Scripts.
So what's the thesis?
The thesis isn't about their next quarter. It's about mid-2026. The company has proven it can execute, it can sell assets at a premium, and management has explicitly said transformational M&A is a focus once those regulatory hurdles are gone.
So the pitch is a bet on the calendar.
Precisely. The outrageous but plausible pitch is this. You initiate a leveraged long position, betting on a forced strategic acquisition by a major peer the moment that 39% national ownership cap is eliminated.
So it's a binary bet on regulatory change.
It is. The idea is that this portfolio, with its unique sports and CTV assets and its high-value local stations, becomes an irresistible target for a bigger player who was previously blocked from buying it.
Remove the cap, and they become a must-buy asset.
Instantly. They become the premium meal for an industry that needs to consolidate.
Yeah.
You're betting a deal gets announced almost immediately after the rule change.
Driving what kind of premium?
I mean, you could be talking about a 30% or more premium on the announcement. A deal that was literally illegal one day becomes strategically necessary the next. It's a bet on political timing, underpinned by really solid asset management.
That is a compelling, if high-stakes, way to look at the next year and a half. So to recap, we covered EWC Scripps' strong execution, their massive progress on delivering the growth from sports and CTV.
And the huge tailwinds from the 2026 political cycle and those expected regulatory changes. When you put it all together, they're not just surviving, they're lining up for a potential home run.
Which brings us to our final thought for you, the learner. How will the convergence of that national ownership cap being lifted and the massive 2026 political spending cycle actually amplify the company's ability to maximize shareholder value, not just through growth, but through strategic M&A?
Think about the leverage they'll have at the negotiating table. That's the question that will define the next 18 months.
Thank you for joining this deep dive. We always appreciate hearing your feedback. Until next time.